Anant Shirgaonkar, Managing Director with Newport Capital, joins us now, and old market hand. Anant, fantastic to have you back on ET now, and thank you for joining us.
Thank you.
What is your current market view?
I think market view is pretty constructive. I think if you look at the valuations, a couple of things, I guess it's not completely stretched. So I think there I differ from the consensus view where most people talk about.
You mean it's not stretched at 9,800, at 10K it was?
No, it wasn't.
Okay.
No, it wasn't. So I'm not, the 200 points really doesn't swing any number in terms of the valuations. So it's gone above average, as you can see. But I don't think it's gone into the euphoric territory. I don't think it's gone into territory wherein typically Indian markets have peaked out, caused a bubble, caused a euphoria. I don't think we are anywhere close to that. So that's one. Secondly, we haven't even seen earnings play out beyond a point, right? So the key question is whether over the next few years we actually start seeing earnings start to pick up. And that's where the valuations will start looking even more attractive than where they are today.
We just talked about earnings, Anant, like in Nikunj notes, that was my theme.
Right.
That every year we start with an assumption of 12-13% upgrades or 12-13% growth, we end up in single digit. And for FY18 also, I think the consensus view is of a 15-16% earnings growth. We may just end up with 4 or 5%.
I think that will play out. So I think to that extent, you're right. In the last 2-3 years, exactly that's the way it's play out. But if you notice, typically the surprise comes in when everybody gives up saying, you know what, the earnings are just not going to come back.
Nobody's giving up, that is my problem. Everybody's hoping.
So till half the year, nobody gives up. And in the third quarter onwards, people start giving up. But let me just point out an important thing that I read about in terms of valuations. So there was this long-term study which was done wherein they talked about scenarios in which when the debt yield is low and when the volatility is low, how does the earnings yield, or rather conversely the PE behave. So typically in a situation like we have today, we have debt yield is pretty low, volatility is pretty low. Historically, if you go back 100 years in the US, PE has been very high. I think that's what explains why the valuations are sticking to these high levels. I think that's why we should not give up in terms of market or valuations till the time we see that the debt yield start moving up or we start seeing that the volatility spikes. I don't think either of those are playing out right now. So there's no need to preempt saying valuations are here and therefore we should start selling out. I think it should be put in context of the debt yield and in terms of the volatility.
So are you buying in this market at 9,800, or are you sitting on some cash waiting for the market to come down a little further?
No, I'm not sitting on cash. I'm buying some stocks. We could discuss that in terms of sectors of stocks. But at some level, I also initiate some shorts to sort of balance. Now this is not necessarily a hedge, but it's actually stocks which I feel can actually give you downside. So it's an absolute return short versus an absolute return long.
Okay. Are you shorting Infi?
I'm not.
Okay.
No.
So where are you going short?
So I think a couple of spaces, I was lucky enough to be short on Pharma for a while, and I'm not cutting them even now.
So within Pharma, what are you short on? The large ones, the mid cap names?
No, mix of large and mid cap. So I wasn't really sure of which particular one stock to short. So I picked 2-3 large caps, 2-3 mid caps. Typically the way I did this was valuations were very high for the sector as a whole. Earnings were sort of becoming tepid and news flow was turning negative. So I think that was a good enough cue to sort of start looking at a sector when the ownership is very high and things at the margin are turning negative.
So when did you go short? And even though you are in the money, in a leverage position, if you are in the money, the temptation to cover is very easy.
Yeah.
So are you in a mood to cover your Pharma shorts?
No, I'm not. As of now, no. So all the Pharma stocks are still short. What I'm trying to do is track either the numbers coming back. I don't see numbers coming back as of now. Last quarter was pretty disastrous for most of them. I want to see news flow come back. I haven't seen the news flow come back in a big way. The original concerns in terms of pricing pressure in the US, that hasn't been addressed. I think most con calls talked about how pricing pressure is going to continue. So if numbers are not flowing in, valuations still remain middling to slightly on the higher side. People haven't really given up on Pharma. Last quarter was the first quarter in which we saw some downgrades and people sort of questioning Pharma. I think it's too early to expect that the stock could start rallying a lot way.
Okay, so Pharma is one short. What's next?
I think paints and media look pretty interesting in terms of shorts. Again, I think the characteristics are similar. If you notice, tremendous euphoria in terms of consumer discretionary space, paints in particular because of property boom and decorative and oligopoly structure and stuff. Couple that with valuations and quality managements, which means that people believe that at any valuation these stocks are a buy. If you notice what's happening in terms of numbers, the numbers are not really flowing through. Volume growth was very, very tepid last quarter. We can blame it on GST, but then let's give it one more quarter to see whether it was GST or whether it's actually volumes not flowing through. Now, we hear people talking about property sector facing slowdown. So originally, if these stocks got re-rated massively because property was doing well, what is the converse of that situation, right? So I think property as a sector can actually start acting as an overhang. Gross margins were down across the board for pharma, for paints. So raw material pressure is starting to play out. They're not able to show volumes, not able to show pricing growth. I think these stocks are completely overowned, very high valuations, and I think that's what.
So go short on Asian Paints. Keep it simple.
That's what my view would be.
Why not short HFCs then? You talk about over ownership characteristics, slowdown in the property market. The biggest proxy is HFCs. Just go short on them.
Yeah, so the point is, I don't really want to short something just because they are overvalued and stuff. I also want to see at the margin things turning a lot more negative, which is what I'm not seeing in HFCs. So on most criteria they qualify, valuations are high, people are seeing euphoria over there, ownership is high, it's a consensus buy, but what is the negatives? So I want to just give it some time, let some stuff start playing out, and then we'll start looking at that position.
The last time we were chatting, you liked some of the niche consumption plays, and without getting into any details, it was more a cosmetic, or I don't know how to explain Kaya. That was the stock that we talked about, and there were others like a Jubilant Foodworks, etc. as well that we discussed. Do you still have conviction in these names? And I believe Jubilant must have worked really well for you.
It has, and I think these are the long-term buys, so 3 to 5 year view. I think the story is to play out in a big way. Jubilant, I think last quarter was the first quarter in which they started showing some numbers. Yeah, so con call was pretty positive. They've identified that the big mistake was in terms of pricing. They've corrected that pricing. The other feedback that they continuously got was that the product isn't good enough, so they revamped the entire product. SSSG came through in the last quarter. This was the first quarter. Typically, when such a stock or a sector moves and corrective actions get taken from the management, the SSSG and numbers can last for a few more quarters, if not a few years. So I think next 2-3 years look pretty interesting for Jubilant.
But it's expensive stock, yeah.
No, as I said, that's why I caveated with that valuation thing. So you will face stocks which will be expensive. I think we will have to have the courage to buy them so long as we think that the story is playing out. We hope that the valuations will get more attractive as the numbers start playing out, and at the same time watch yields, watch volatility to sort of think about whether the valuations need to be questioned for the market as a whole.
What about Kaya? Is that still a hold?
Yeah, I'm still holding. I'm not buying or adding anymore. But I think Kaya again is the next 2-3 year story. It's actually a much longer term story, but I'm looking at a re-rating in the next 2 to 3 years. The numbers got affected, one because of demon and overall affluence and consumption going down. But the big story that I'm playing over there, apart from beauty and wellness and stuff, is the anti-aging. So anti-aging is going to become a very, very big theme in India in the next 10, 15, 20 years. Kaya is going to be the leader in that space.
But I thought India had a young population.
No, but
this is not Japan.
The point is this, right? So at the margin, every single person who is earning decent amount of money, once he crosses 35, 40, 50, he starts to be willing to spend more money to look younger in whatever form. I think that's going to be a very, very big opportunity for Kaya.
Do you have any long leverage positions? Because Kaya, Jubilant Foodworks, I would imagine they're part for your core portfolio.
Absolutely, yeah.
So when you go short, you have a near-term view because you create a leverage position. Are you creating any leverage positions for next 1 month, next 2 months?
So it's not a 1 month, 2 month thing. It's typically at least 6 to 12 months.
Okay, you keep your leverage long for 6 months.
Yeah.
You keep on rolling over your futures.
Correct. Yeah.
So what are you rolling over on the long side?
So I've been long metals and oil PSUs. And
oil PSUs.
Yeah. So I think so it's a very narrow space. Beyond this, I'm not really leveraged long anywhere. But I think both these spaces look pretty interesting even now.
Okay. When you say you are long metals, and metals may look like a small sector, but it's a very large sector to understand. There is ferrous, there is non-ferrous, there is alloy and there is non-alloy. There is Vedanta on one side and there is Tata Steel on the other side. Are you buying metals as a basket or you are selectively buying metals?
So I don't want to sort of differentiate between ferrous and non-ferrous. I don't think I'm an expert in metals to sort of zero down saying steel is going to do well but aluminium is not going to do well. So that's not a view that I'm going to take. The way I'm taking a view in metals is basically it's proxy the dollar depreciation. So the US and US politics is sort of in a quagmire in terms of they're not able to pass any legislations. It's going to affect the US economy negatively. I think it's going to affect the dollar negatively and the dollar depreciation. We've already seen part of that play out, but I think that's the big theme to look out over there. And I think metals are going to be a great proxy for that. Apart from that, you've seen, the China angle and the Indian government sort of, helping the local producers in terms of price protection and stuff. So it's a combination of these 2-3 themes, but the big theme is the dollar proxy.
The other trend in the market before this bit of profit taking set in was the new IPO space, the newly listed space, and the other one were these debt-laden companies. So even some of those stories are playing out now, the likes of a DLF, GMR, JP Associates, etc. Do you have any exposure to this pocket?
So I looked at this space, and originally my concern was that the management quality doesn't sort of give me comfort. But having done a lot more work on that, I think there could be some angle over here in terms of debt-laden communications or telecom company, wherein you could actually see that the company announced saying 1 or 2 deals are already being done in terms of selling tower, in the process of selling some land, or in terms of merging with some other company, which could actually help if the deals were to go through, the debt could come down significantly. Now the only question is whether the approvals for these deals come through. Now that's in the pipeline. We've already seen NCLTs invited or admitted the plea. The hearing could be sometime in September. I think rather than betting on companies or stocks wherein we don't know how they will deleverage, I think it's better to bet on a company wherein the deleveraging deals are already done, approvals are pending. You could still go wrong if the approvals don't come through, but I think the risk is mitigated by going for such a.
So play seen, don't play blind. Yeah. That's a poker terminology, right?
Yeah, but I think it just reduces your risk significantly. You could still go wrong.
Getting up for Diwali already, Nikunj.
Yeah, I don't know how to play poker, but I'm learning. There's a nice poker gang in my building. So it's like I'm a kindergarten student trying to understand poker. So it's not a card game, it's a game on psychology.
Yeah, I know.
So, well, this is a stock market show, so we won't talk about poker, but appreciate your time.
Thank you so much.
Thank you for joining us.
Cheers.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.